Good day, wherever you might be. Thanks a lot for joining us. We're here for a review and discussion of Osino's definitive feasibility study, announced today for the Twin Hills Gold Project in Namibia. The founder and CEO of Osino, Heye Daun, is on the screen. You should see him, and he will provide a company presentation now that'll go about 20 minutes, after which he'll answer your questions. You should see a Q&A button at the bottom of your screen. You can submit your questions at any time during the presentation, and Heye will answer them at the end. Without further ado, Heye, please go ahead.
Great, thank you. For those of you who don't know, Yaron is our corporate development manager. Thanks for the introduction, and thanks for putting this together, and thanks for everybody to dial in. As you know, Osino is a gold mine development company focused on Namibia. We discovered the exciting Twin Hills project, which we explored intensively over the last few years, have done a couple of studies on, which I'll talk about, which is now culminating in this DFS where we have published the results today. We're very pleased with the results of this DFS, which confirms Twin Hills as a technically simple, long life, low cost gold project with very strong economics and plenty of upside. Now that the DFS is completed, we will immediately commence with the follow-on steps like initiating a FEED, front-end engineering design, financing, closing the last few loops on permitting in order to progress this project into construction after full project financing. I think the DFS clearly demonstrates that Twin Hills is very robust, it's highly cash generative, and will deliver outstanding returns to shareholders once it goes into production. So just a forward-looking statement. By the way, so this presentation is on the website. You can refer back to it. Some of the slides are quite detailed. I won't go into too much detail on them. You can refer back to it in your own time. So just very briefly, a quick update on who we are and what we're doing. We are an accomplished team, both in terms of building companies, discovering resources or gold deposits, advancing them, and in cases in our history, we have also sold projects in the past. So we've been on all sides of the table, and we're not doing this for the first time. The project value is obviously backstopped by the Twin Hills Gold Project, which we've just completed this definitive on, and which we are continuing to fast track through development. We still have a very supportive and strong shareholder base, which has stayed very constant over the last couple of years. And there's a lot of upside still beyond the definitive, which is not reflected in the valuation of the company yet. And obviously, you get all of that for a low valuation, which I think is obviously a key for shareholders. We're in Namibia in the Damara mineralizing belt. It's a tectonic belt, sedimentary hosted, structurally controlled. It currently has two gold mines. This will be the third one, and a couple of additional exploration projects, one of which we own and some which are owned by others. There's certainly a lot of activity in Namibian exploration at the moment. A new discovery was announced only a couple of weeks ago, not far from us, and we are having some very interesting earlier stage exploration results in other areas of our portfolio. But the focus is, of course, on the Twin Hills project, which is down at the bottom of this image over there, if you can see it. We're located in sort of central Namibia, in an excellent location, very close to infrastructure, very close to an existing gold mine, and obviously in a great location for this project to be developed. We drilled it extensively over the last few years. We've completed around about 225,000 meters of drilling, which has brought the Twin Hills project to the indicated stage. It's mostly indicated. We have some measured resources. We've done grade control drilling and other confirmatory drilling. And all of this drilling has been converted into a mine plan and a feasibility study, which we're announcing here. So on the feasibility itself, the key results, maybe in summary, I should say we are very, very happy that we've been able to confirm most of the numbers from the pre-feasibility study. Reminding you, we put out a pre-feasibility in September last year, And this definitive builds on that pre-feas and improves on it. The biggest difference between the pre-feas and a definitive really is the quality of the estimate. A definitive is based on quotes, whereas a pre-feas is largely based on benchmarking and factoring. So we have a much tighter capital estimate, and we're very pleased that the capital, instead of going up, which is what certainly most Canadian observers expected to happen, we've been able to keep the capital to within the same range that the pre-feas had. In fact, we've been able to book a slight saving. We were hoping that there would be a bigger saving, but some of the project enhancements that we've undertaken, in particular filtration and tailings handling, have resulted in some increases, which basically resulted in the total development capital of about $365 million. The operating costs were also you at the pre-feas. Our all-in sustaining costs per ounce life of mine were around about $940 per ounce. That's crept up slightly to around about $1,011 per ounce life of mine. For the first few years, obviously those costs are lower, and these increased costs have resulted in a slightly reduced total project value of $480 million. Reminding you that pre-feas was $503 million. We also de-risked the pre-feas mine schedule and mine plan somewhat, just by being slightly less aggressive on the production rates, evening out the production profiles and so forth. And that's costs a little bit in extra value as well. But altogether, I think almost $500 million of project NPV at 5% discount rate and street consensus gold price, which is $1,750 per ounce, is a very pleasing number, and obviously many multiples higher than our market cap. The returns are very good, very strong IRR, quick payback, long mine life, 13 years, and generally very, very credible numbers that have been substantially de-risked. The project, okay, sorry, I had my ordering wrong here. So it is a stock standard open pit gold project hosted in a classic orogenic gold setting. It's conventional open pit mining. We've got one big main pit, Bulge and Twin Hill Central, which you can see in the center of the image there, and 3 satellite pits. All of these satellite pits grew as we went from pre-feas to definitive, and I think as we keep on drilling and expanding the resource, those satellite pits will continue to grow. The processing layout has also stayed largely the same. I must just say this image, unfortunately, is still from the pre-feas. I haven't updated it. My apologies, but that's okay because the processing layout has stayed largely the same. It's 3-stage crushing, followed by gravity recovery, CIL, and then a dry stack tailing system. We've done a lot of work on the tailing system. We have introduced filtration. That has been one of the scope changes since the pre-feasibility. We've done a lot of work on additional filtration of tailings material, getting the water content down from about 22% to about 16%, which de-risks the tailing system because it makes it easier to stack the material. But pleasingly, obviously, it also results in a much lower water consumption. But it has resulted in some additional capex, mainly for pressure filtration and some of the conveying equipment that's necessary to stack this material. We do expect that as we move forward with this project and as we do the detailed engineering design, we might be able to save on some additional capex there by enhancing the filtration techniques used further. Other than that, we also took out the HPGR, which you can see in this image over there. We've replaced that with a conventional 3-stage crushing, which has made the processing layout a little bit more conventional, a little bit lower risk for a project in our location. So just a couple of graphs on the production profile. So top left is the mining rate. So this is going to be a 35 million ton per annum open pit gold mine. In the sort of global scheme of things, it's a large tier 2 open pit, but quite manageable. It will be done with 3 or 4 excavators and probably 20-24 777 Caterpillar haul trucks, and very, very constant mining rate over the life of mine. The processing throughput, the mill feed below that at the bottom left there, is still set at 5 million tons per annum. It's the same scope that we had in the pre-feasibility study. And on the other graphs, you can see top right, just the contribution of mill feed from the various sources from the 4 satellite pits that we have. And then at the bottom right, you can see the gold production profile, which if you compare that to the pre-feasibility study, is somewhat de-risked because we've just evened it out a bit. So in the pre-feas, we were very hung up about achieving 200,000 ounces a year for the first few years. And we've dialed that back a bit to an average of about 162,000 ounces per year for the life of mine and about 175,000 ounces for the first 5 years. And that's, again, very credible, very nice tier 2 type of operation in terms of gold production profile. We have worked with some exceptional, I can even say world-class engineering consultant and specialist consultants who completed all the specialist studies that went into the definitive. At the top there, we had Lycopodium and DRA, who were the lead consultants, Lycopodium focusing on the processing plant and DRA on the infrastructure. For those of you who are not familiar with these companies, I can say without doubt that these are probably the best gold and mine builders, gold mine project builders, certainly in Africa, but even on a global scale, these are world-class engineering consultants. What I also should emphasize here is that we have stuck with these companies throughout the various iterations of studies that we've done over the last few years. Remember, we did a PEA in 2021 with Lycopodium. We then did a pre-feasibility study in last year, at the beginning of last year, and we did an expanded pre-feasibility study. The first pre-feas wasn't announced as such because for those of you who have longer memories, you'll remember we had some extra ounces. We added another 3 to 6 months, and we then put out the expanded feasibility study in September, which has now been followed up with this definitive. The reason I mention the continuity of engineering contractors is because it is a very significant de-risking step. So having completed all these various iterations of studies over the last 2 to 3 years has obviously de-risked this project substantially, because with every step and every new iteration, we fine-tuned and optimized this processing plant with only incremental scope changes. And so that's a key factor that doesn't come out in the press releases and in the quick presentations, but it is a major de-risking step. Going forward, obviously, we will have to decide on one of these 2 consultants. We haven't made that decision yet. That's the next step. We will select one of them and then move into what is called FEED, front-end engineering and design, which is a sort of a 4 to 6 month process that we will initiate more or less immediately. And that's designed to produce detailed engineering drawings that will enable us to order long lead items like mills and crushers and other things. At the moment, we are still in time. As long as we make these long lead item orders in the next, call it, during the feed period or at the end of the feed period, and then the project schedule that I'll explain later is still intact. So very pleasing to have worked with Lycopodium and DRA. And as I said, they are really the top guys, the go-to mine builders and gold processing plant builders, certainly in Africa, but also worldwide. And the rest of the consultants in the same vein, we've worked with the best who we can find. And all of these companies have done an exceptional job delivering the project to where it is. Maybe just some comments on water. This has always been recognized as a key project risk because we're in a dry country with I wouldn't say a stressed water situation, but certainly we wanted to be independent to some extent of the national grid. We are in a infrastructure dense part of the country. You can see in that diagram at the bottom left, we within 15 kilometers of our project site, we have a local mining town. We have another gold mine that's been in operation for 30 years. We have access to power and access to water. Yes, we will help. We will have to help bring that to site, but it's close, and And certainly on the water side, to get back to that, we've put a lot of effort into developing a diversified water supply strategy, which has a very significant safety factor in terms of the maximum and the sustainable yield of the different water sources that we have. So this is obviously very pleasing because we're very confident that the water supply situation has now been addressed. Same for power supply. So this mine will be grid power supplied. Namibia has a very professional, well-functioning national grid. And we will have cheap power from the grid augmented with a very large 30 to 40 megawatt solar system that's included in this capital estimate. So from the utility side, the project has been substantially de-risked. In terms of the site layout, I mentioned most of this. I can maybe just add, if those yellow dotted lines that you see at the top right there that encompass or envelope the project site, that's private farmland that we have acquired. We've paid for the northern piece. The southern piece is currently being transferred, and we're in the process of paying for it. But effectively, we now own all the land that the project sits on. That's another very significant de-risking step that's been undertaken. And so obviously, in summary, we have an exceptional location to build this project, and that's reflected in our relatively low capital intensity that I'll show in a bit. So just on the project development timetable, so now that this definitive study is out, what's next, or what does that mean? So reminding you, this sort of 5-year timetable that you see here is very much the life cycle that any mining project would go through, from exploration through studies into engineering and design, where we are now, and then into implementation. In between engineering and implementation, obviously, comes project financing, concluding permitting, and building the capability for us as a junior and single asset developer to be able to implement this project. So the definitive clearly was targeted primarily at banks and project financiers. So we have had an extensive process that has been running over the last year, where we worked with a boutique UK-based specialist debt advisor called Terra Franca, and they ran a process whereby we got debt proposals from the whole range of mining financiers, from streamers to private equity funds, credit providers, even some banks. We're in the process of progressing those providers, and we hope that very soon, in fact, in the next month or two, we should get credit approval on a comprehensive financing package that will substantially finance the construction of this mine. Of course, there's going to be some equity required that we will have to raise later this year, and how exactly we put that puzzle together is going to unfold now that we have the accurate capital estimate. So that's on project financing. The idea clearly, or the aim or the ambition, is to have all of that in place: detailed engineering, implementation capability, and financing by the end of this year, so that we can make an investment decision by the end of this year to build this mine and move forward. Now, I know a lot of you are asking, oh, well, do you really want to build it, or what is the strategy in that regard? So let me just deal with that over here. So our role as management of this company and shareholders of the company is to create value. And we are currently in a process whereby we are evaluating a number of strategic options to create that value. Yes, of course, it would be nice to get a. It would be very nice to get an approach from a corporate entity to potentially build this mine with them. And as you can imagine, we've got an active data room. There are a number of conversations that are taking place. Nothing is certain, nothing is final. And there's no certainty that this will happen. And that's why we are focusing on what's within our own control, which is to deliver a standalone plan. And just to reiterate, that comprises detailed engineering, project financing, implementation capability, so that we can pull the trigger and make an investment decision at the end of the year. So that's where we're heading for. Subject to financing falling in place. Obviously, this is also to some extent dependent on market conditions and so forth. But subject to financing being in place by the end of the year and subject to the permitting having been concluded, if we then were to go into construction at the end of this year or early next year, it would be a 2-year build period with first gold under the scenario expected at the end of 2025 or early in 2026. On the permitting side, we are far advanced as well. We do have an approved mining permit. We have an approved environmental authorization. We are currently busy procuring the site-specific permits, which are not entirely under our control, but they are expected to be delivered within this time frame. And then we've got a couple of other smaller items ongoing to achieve that. So at the moment, we are looking very good to achieve this timeline and to achieve an investment decision towards the end of this year. This is what the project site looks like. I'm sure that a lot of people on this call would have actually been on site already. It's flat, it's dry, it has a lot of infrastructure around, and so it really is an unbelievably good location to be building a project site. And we own virtually all this land that you can see on this image over here. So let me just talk briefly about implementation capability. So this is our current board of directors, Alan Friedman and I, top left there. We're the founders of the company and obviously the sort of key drivers. We have a world-class exploration team in place who have discovered this project and who are in the process of making additional discoveries. We do not yet have an implementation capability, but we do have a quality study capacity through our study manager, Charles Creasy, and study director, Steve Burks, who have been managing all the consultants that I mentioned earlier, who have brought us to this point with the publication of this definitive study. That study capability, or these guys, or the existing team, are perfectly sufficient to see us through the FEED process that I mentioned earlier, front-end engineering design, 3 to 6 months. And during this FEED process, i.e. over the next 6 months, we are going to be hiring an implementation team, starting with a project director. In fact, we have advertised. We've got a range of very credible CVs already. We will be appointing headhunters to appoint primarily a project director, and then we will construct around him, we will construct a small owners team, 10 to 15 man owners team, comprising a project director, probably a mechanical engineer, civil engineer, some clerks of works, a construction manager, and some contract management and procurement capabilities. That owners team will then oversee an EPCM contractor. EPCM stands for Engineering, Procurement, Construction Management. So the EPCM contractor, very likely either Lycopodium or DRA, will be the lead contractor who will be building this mine with the support and under the supervision of the owners team. So really what I'm telling you here, the picture that I'm painting here, that a single asset developer like ourselves are perfectly capable of building a project like ourselves. That's what we're setting out to do. Just a couple of words on responsible mining. As you know from our press releases and previous reporting, this has always been close to our heart. We're in a big country with not a lot of people. It's the society and the regulators in Namibia are highly supportive of mining. They want us to succeed. They want this mine to succeed. They want to see it being developed as soon as possible. Now that support didn't come from nothing. That support came from a very strong social license to operate that we earned through our strategic sustainability efforts that we have been progressing. We've had a number of third-party bank and finance due diligences that have visited the project. In fact, as recently as 2 or 3 weeks ago, we had a very credible and very large financing institute that visited us with their technical consultant. And the refrain from all of these visits has always been that our proactive approach to responsible mining has contributed very materially to the robustness of this project. And we will continue in that vein. All right, so I'm not going to go into all these numbers. This is on the website. You can go through it yourself. It's a summary of the financial model, gives you all the key numbers. I just want to point out to you the line at the bottom, the cash flow, the net free cash before tax, over $1 billion at 1750 gold. If you put in spot prices, we have net pre-tax cash flows of just under $1.5 billion that this project will generate. And that discounts some very realistic assumptions on costs and capital. And I'm emphasizing this point to make it clear to you how good this project is, the quality, the cash generation potential that this project will bring to bear. You can see the numbers down there at 1750 gold. In the first year, we are going to produce over $200 million of free cash. So effectively, we have the potential to pay back the debt within the first year already. So we are, we are certainly technically capable to implement this project, but this project is also financially robust enough to sustain project financing and a high level of debt to finance and build this project. You can look at the numbers obviously in your own time on the website. Just on the capital, again, not going to go through all of these numbers. Reminding you, the pre-fees had a capital cost of $375 million, including contingency and pre-strip and some other non-mechanical items. The definitive is marginally lower at $365 million. And as I mentioned earlier, I think there is some scope to potentially achieve a few more savings. But if not, certainly this is it's a high conviction capital estimate, and we believe that the risk of future capital escalations is very low. Okay, so in terms of positioning, where does that put us relative to our peer group? So on the cost curve, all-in sustaining costs, we are right at the bottom of the curve at around about $1,000 an ounce. Obviously, a very good place to be. Tells you something about the robustness of the project and the margins that this project represents. In terms of capital intensity, it looks very good too, and that's really mainly a factor of the location, the jurisdiction being in Namibia, weak exchange rate, relatively low capital intensity because of the ease of bringing power and water to site, no need to have a major construction camp, etc., etc. So very good capital intensity, which probably brings me to the key slide from an investment perspective, and that is our valuation measured by price per NAV, where price, let's say a proxy to price could be our market cap, divided by the project value using street consensus gold prices. So we are comparing apples with apples here. You can see all the way on the right-hand side, the senior producers are trading beyond 1 times NAV. The mid-tiers are trading around 0.8 to 1 times. The single asset developers, like Osino, for example, just into production, trading at about 0.5. We're trading at about 0.33. And of course, this is the essence of what we're doing. It is to re-rate with ongoing execution and de-risking. These are the things that I mentioned earlier, like concluding permitting, concluding feed, ordering long lead items, concluding project financing. All of these de-risking and execution steps ordinarily result in significant share price re-rating. Of course, if M&A or a corporate event or corporate action comes around in the meantime, it's a way to fast track this re-rating, but we can't control that. And that's why we are focusing on our standalone plan. We do have significant exploration upside left. So I'm absolutely convinced that this project will continue to get better. And even further afield, I mean, this image that you're looking at here is just the brownfields exploration where we have some very interesting sniffs. No fire yet, but before you get fire, you need to see smoke. That's what we're seeing. But further afield, regionally speaking, our exploration efforts are ongoing, and we have some very exciting stuff happening there. Hopefully, a potential to make another discovery in the future. And we will find ways to catalyze that extra value, which is currently not reflected in our share price at all. We could consider doing a spin out of the exploration assets, etc., etc. Obviously, we need to ensure that if we do such a spin out, it needs to have critical mass. So that's all work in progress, but we are focused on extracting further value from the rest of the portfolio for our shareholders. So that brings me to the end of the presentation. So in summary, we've got an accomplished team. We know what we're doing in terms of building the puzzle, raising money, pushing this forward. We are backstopped by an excellent asset, the Twin Hills project, which is low risk, low cost, near term, and continues to be fast tracked. It definitely will be a mine. We've got some excellent shareholders that are very supportive and continue to be there when we need them. Lots of upside that I mentioned, and I think we are primed for re-rating. So that's it. Let me pause there.
Excellent. Thank you very much for the presentation, Heye. For those that are joining a bit later, my name is Yaron Conforti. I head corporate development for Osino. I'll be sharing some of the questions that were asked during the presentation now, and I will respond. If any of you still want to ask questions, feel free to enter them. There's a Q&A button below on your screen. So Heye, if you're ready to go, one of the first questions that came in was on sustaining CapEx. Wondering what the cause of a reduction in sustaining CapEx was from the PFS. Can you speak to that?
Yeah, so the biggest driver of sustaining CapEx is the modular nature of the dry stack tailings facility. The way it works, in fact, I can show you, I'll try and while I talk, I'll go back to the site layout and you'll get a sense. So this big purple patch that you can see on the image over here is the dry stack tailings facility, and that will be constructed modularly. So
I think that's the wrong image. Yeah, there we go.
Okay, can you see it?
Yeah, thanks.
Okay, so you saw the picture, the flat ground, and we're building a dry stack tailings facility onto it. That's what you're looking at over here. We'll build that in stages. So initially only the first phase, and then I forget the exact number, but in year 4 or 5, we add to it. So that's in sustaining capital. I think the question that was asked why there was a slight reduction is because some of the sustaining capital is now included in the operating cost, because the sustaining capital in our case really is only the maintenance costs. Because remember, unlike Ozone, for example, who built an oxide plant first and then they have sulfide plant construction, sustaining capital, etc. We don't have any of this. We built this entire plan out of the gates. So the only thing that's in sustaining capital is the addition to the dry stack tailings facilities, the obviously ongoing capital to maintain to actually maintenance costs is in the operating costs, but any other additional capital and then closure costs. So that's it. But sorry, it's maybe not enough detail. I'll send you an email. I did get that email, and we'll give you an exact breakdown where the changes were.
Great, thanks. It's a good reminder to everybody. Feel free to contact us by email. My email address is on the press release. We'll be happy to reply to your questions in detail if we don't have time for them today as well. Another question relates to Ondundu. Has any additional work been done on Ondundu, and how could that project factor into the plan for Twin Hills?
Yes, I'm just going to race to that slide. So yes, quite a lot of additional. So here's our license position in Namibia. It probably will show up on your screen shortly. Can you see the blue dots in the license position you're on?
Yes.
Okay, so Ondundu is in the northwest of the country. It's about 150 kilometers from Twin Hills, maybe a little bit more. It is not within conventional trucking distance, so you can't load the stuff at Ondundu and truck it down to Twin Hills. But Ondundu has very high gravity, amenability to gravity or sorting technology. So you could potentially mine it there, crush it, sort it, concentrate it, and then truck a concentrate down to Twin Hills. We've communicated this plan before, and that plan is still on the cards. Further work was done. We've done additional drilling. You would have seen some of those excellent drill results. So it looks like Ondundu will keep on growing because we intersected some unexpected additional veins and additional metal. But we also did quite detailed additional metallurgical test work to prove up that processing route that I just described. We haven't communicated it. Originally, the idea was to publish a PEA on Ondundu this year still. But obviously, as the markets became so weak, we went into sort of capital conservation mode, and we just felt that we wouldn't get credit for a full-on PEA, and we just did the technical work in the background. But yes, so certainly we continue to work on the co-development route of Ondundu with Twin Hills in order to use Ondundu to turn Twin Hills into a 200,000 ounce plus per annum gold producer. But also importantly, we've done additional exploration work at Ondundu. I mentioned that just now. And so we believe that there is a significant scope to improve the Ondundu resource itself. And then thirdly, we are actively exploring in the Ondundu region in the sort of 30, 40 kilometer radius, and we are seeing some very interesting results. We haven't got assay results yet, but the visual interpretation on some of the exploration we're doing is very encouraging. And that's why we're bringing some additional resources to bear to try and fast track that, to see if we can pull a rabbit out of the hat over there. So watch this space.
Great. That was a comprehensive update on Ondundu. I'll take from that. We should all stay tuned. Another question coming in specific to Namibia. So are you concerned that Namibia will become like Chile by becoming more nationalistic and imposing further taxes and royalties?
Yes, it's obviously a very relevant question with the latest press that we saw coming out of Namibia, which was unfortunate. So my short answer is I'm concerned. I don't think this will happen. And I say that with the conviction that comes from being a Namibian, having lived in Namibia, and having been party to multiple sort of project advancements over the last few years, particularly B2Gold's Otjikoto mine, which got built, and then our own. So I am pretty confident that the Namibians will remain responsible. They've communicated quite clearly what their ambition is in terms of local participation in gold mines. Unfortunately, this press release that was put out 2 weeks ago or so sort of mischaracterized that a bit, but it hasn't been a surprise. We've always known that the Namibian government wants us to make available a stake in the project at the 5 to 10% level to local investors, not for free, paid for. And we are working towards that. In fact, our mining license stipulates that we have to put a 5% local ownership in place, and we've started that process. But it's not a giveaway, it's not a free carry. And in fact, we will try to do more than 5%. We will try to do 10%, depends on the appetite that we will get from local investors. But it's not a freebie, and I think it's entirely reasonable of the Namibian government to ensure that there's local participation in mining projects in country. So no surprises, and I think it's going to be, I don't expect further surprises in the future.
Great. Another question here. Congratulations on a solid DFS, exclamation point. You highlighted water as a key project risk and grid power. Can you update on the situation of the planned Irongo substation, please?
Yes, so we signed a power supply agreement with the Namibian utility quite a long time ago, last year already. We've been making payments, so they are committed to a timeline, which contractually it states it's 38 to 44 months from signature. So we are within that timeline, and under the terms of that agreement, NamPower will build what they call the deep connection, which is the substation, and we will build a 24-kilometer overhead high tension power line. The process on that power line has started. The EIA and public consultation, etc., has started. So I think that certainly the power line itself will be no problem. But the question was on the substation. We've been given assurances by NamPower, which is the grid operator in Namibia, that they can achieve this in time. But I do think that we need to stay close to them and make sure that that this does happen in time, because public procurement in Namibia tends to be, slow at times. But we do have 2.5 years or so. So our base case is that grid power will be delivered in time from that substation. We're not the only user, by the way. There's the other gold mine expects to be tied in, and there's a significant lithium project that's being developed, which also needs additional power. So there's quite a bit of pressure on them to deliver, and I think that they will deliver.
Excellent. Switching gears a bit, someone's wondering about the agreement with Newmont. Now, they phrased the question as, when will a decision be made regarding a JV with Newmont? Can you speak to that now?
Yes, I understand it's a bit of an odd one, because we published the fact that Newmont was interested in talking to us. We had to do that because Newmont was on the ground doing a very significant orientation survey on Twin Hills to test their proprietary geochemical screening technique that they've used elsewhere. In particular, Dave Underwood, our VP Exploration, he said, so he brought Newmont to the party, and Newmont is interested fundamentally in exploring the Damara Belt, and they're looking for a credible partner to do that with. So it's in that vein that the conversation is taking place. Obviously, with the corporate, how the company is evolving in terms of the development of Twin Hills, our focus is on financing the construction of Twin Hills, and everything else needs to support that. And that's what we have to figure out with Newmont. What is the best way to potentially do this with them? That's good for our shareholders, that leaves enough value for us, and that is attractive to Newmont. So at the moment, we are not committed to Newmont at all, but we are honored by the fact that a highly credible group like this, the biggest gold mine company in the world, wants to work with us, and you can't dismiss that, and that's why we take them very seriously. And we're trying to find a way to bring them in. If we were to do a spin-out, for example, obviously it would be fantastic to have an anchor investor like that on our side. But that's where it is. At the moment, no certainty, ongoing discussions on a very friendly basis.
Great. And again, as a reference for those that want to learn more about our collaboration with Newmont, we did release a news release. You'll find it on our website. It goes into some great detail about that collaboration. There's another question coming in, I'm guessing a local Namibian question, which is how many people could be employed at the mine?
Yes, so I speak a little bit under correction. I don't have the exact number here at my fingertips, but broadly speaking, you will have a large ramp up during construction. I expect that during construction, we will probably have 1,000 or 1,500 people, possibly more, working on site. But post-construction, that will come back probably to around about 1,000 people. That's more or less the number of employees, a little bit less, that B2Gold has up at their mine. Our mine will be a little bit bigger than Otjikoto in terms of processing plant size and throughput, but it's in that range, probably in the 700 to 1,000 people. And yeah, so it's significant, but obviously the secondary jobs that created through procurement of goods and services, etc., are, I don't know what the exact multiplier is, but it's probably like 3 or 4 times that. So it's a very significant number in a sparsely populated country like Namibia. It may not sound like much in North America, but it's very significant in Namibia.
Got it. A separate but somewhat follow-on question, which is, with the Navakhab gold mine nearby, are there opportunities for synergies not included in the DFS? Can you comment on the availability of skilled labor in the region?
So Navakhab is obviously owned by a different company. So there are no synergies as such that we could include into a definitive study. But conceptually speaking, of course, it would make a lot of sense to cooperate and collaborate with Navakhab. And in fact, we already are. We've got an ongoing dialogue with them. We are copying. We've tried to copy some of their processing techniques. They've done some very creative upgrading of lower grade materials, etc. So we're trying to learn from them as best as we can. At the same time, in Namibia, the relationship in the mining industry is very gentlemanly amongst each other. So we don't poach from others where we can. But there are enough skills available in Namibia. Namibia has a long established mining industry. There are enough operators, mining operators, plant operators, engineers. In fact, it's very different to Canada. It's important maybe to delve on this point a little bit, because one of the questions we get a lot from Canada and North America is the dearth of skills that you guys experience up in Canada. In Namibia, we don't really have that in South Africa. I mean, on the one hand, we've got lower economic growth, and I guess that's one factor, but certainly there are enough engineers available, enough operators, enough people. So I don't expect a problem acquiring the necessary skills. In fact, I think the bigger challenge will be to ensure that locals, true locals from the surrounding area, have access to jobs with this project. And that's a very topical, not political, socio-economic issue that we're quite focused on.
Great. Diving back into a bit of the details of the DFS release today, the question comes, all-in sustaining costs increased marginally in this DFS. Can you elaborate on the increase, especially in context of exchange rate assumptions and proportion of local versus US cost mix?
Yeah, a couple of things. One is reagents and consumables, particularly steel balls and cyanide and reagents. They haven't come down as much as we thought. Some of them have increased. Diesel prices, so mining costs have gone up. That's just generally inflationary increases. Even in Southern Africa, we've been subject to that. I think the fact that the costs haven't gone up more is an indication of some of the cost hedging, natural hedging that takes place as a result of the exchange rate depreciation. That's one of the reasons why our costs are still actually, you know, if you consider that the all-in sustaining costs have, in inverted commas, only gone from 940 to around about 1,000, that's around 5% increase. I think that's a real achievement, which has mainly been achieved on the back of that depreciating exchange rate. I think those are the main aspects of the cost. Sorry, I had another thought, but it slipped my mind. I'll come back to it.
Okay. Switching gears again, the rationale behind the potential LSE listing. So we did disclose recently, for those that didn't see in the news release, that the company was considering potential listing on the London Stock Exchange. So the rationale for the question, yes. The rationale for that, please.
Yes, certainly. I mean, the short answer is we're trying to get as many new eyeballs as possible, and we will look for them wherever we can find them. The Canadian market, it's no secret if everybody knows this because you can see it in the share price, the Canadian market has been weak, and we have a wide range of Canadian and North American investors. And so we have to find new grounds where we can find new investors, new buyers. Obviously, it's also in preparation of a future financing as part of the build financing, because, you know, if we're going to raise a significant amount of money, I think we need to look beyond Canada. But it's not just the LSE. We are also contemplating others. Like, for example, I met with the Johannesburg Stock Exchange the other day. All of these exchanges make it very easy for you to list because they accept your home country regulation. So it's not as scary as it sounds. So basically you get regulated by the TSX. It's a mirror listing, it's a dual listing, but it does make it easier for some of the investors in those other countries to buy the stock. In particular in the UK, we are interested in targeting more of the generalist small cap funds. These are guys that have never invested in us before. And there's a whole universe of investors in London that understands Africa and Namibia in particular much better than the North American audience. And we want to actively target those investors. That's why we're contemplating this.
Got it. There's a question coming in about drilling. So is there a planned drill program for the remainder of the year? And if so, will it include Sandveld? Which is a
yes,
target, for those that don't know. Sandveld is one of our targets, exploration targets.
Yeah, so we do have a planned drilling program for the end of the year. It's, as you can imagine, it's primarily focused on condemnation drilling and infill drilling at Twin Hills, some infill drilling to do additional grade control, etc., just to de-risk the project a bit further. Some brownfields drilling to try and make additional brownfields discoveries because they immediately go to the bottom line if they're within trucking distance. Some true exploration drilling in the Ondundu area. I told you earlier, we're quite excited about what's evolving at Ondundu. So we're going to do a bit more drilling there. At Sandveld, probably no drilling, although some drilling, yes, some RAB drilling probably. At Sandveld for now, we have to do screening. Sandveld itself, for those of you who don't know, it's a new chapter that we opened along the same structure that hosts Twin Hills and Nabachab. So basically you've got 10 million ounces down here. On those same deep-seated structures, we've secured a very large license position, about 2,000 square kilometers, but it's true greenfields. So we've got to generate targets there first before we can drill them. And we're doing that through screening, surface sampling, potentially using Newmont's technique. And if that throws up some nice targets, then we'll drill them. But it's hard to say at this stage whether that will happen this year already or not. Probably towards the end of the year.
Some more concerns about water, it seems. So the question reads, Namibia is a dry country. Could water supply run dry? If so, what would be the alternative measurements, or would there be enough water?
look, Namibia has enough water, but it's not always in the right places. So in our case, for example, I mentioned at the beginning, geologically speaking, we are in a sedimentary belt. What that means is we've got these marble geological formations that run throughout the entire country. Those marbles, by definition, contain water, and they get recharged through rainwater. Now, Otjikoto, the B2 gold mine up there, relies entirely on those marble aquifers, and they have pumped them without having a negative impact on surrounding land users. So that has been our base case, and we are going to do the same, except that in our area, the recharge is a little bit less, and that's why we had to come up with some additional sources, so that because obviously our sustainable yield down here is somewhat less. But we've done extensive work to prove up what the sustainable yield can be, and we have redundancy and additional sources as a fallback position. So we definitely will not run out of water. But importantly, we have to demonstrate that when we pump, we are not going to have an adverse effect on our neighbors. And that's what our studies are showing. And that's why we are looking at some of these other infrastructure investments. In particular, we're contemplating this aquifer recharge scheme to the north of us. We're contemplating building a pipeline to another aquifer that was offered to us by the Namibian water utility, which is a little bit further away. Now, these infrastructure investments are very good for the country, because obviously they result in infrastructure investment that other users can also benefit from. So I think we've got a very well thought out, well-founded water supply strategy that works. And I'm confident that we have enough water, and we are not going to run out of water, and we are not going to negatively impact other water users.
All right. Just let everyone know, if they didn't see a 5-minute warning, we're about at the end here. So I'm going to make time for one more question here, and goes back to the details of the study. Just give me one moment, please. So with regard to spot gold prices, can you comment any further on the cash flow impacts on spot gold pricing versus the $750 gold price that was used in today's DFS?
Yeah, very simple. I mean, if we put in spot prices, then the pre-tax cash flows of this project are just under $1.5 billion US. It's very significant. Now, obviously, that's a life of mine cash flow. But where it really counts is in the first 2 years of production, because that's when you pay back the loans. Now, at spot prices, we will pay back the project debt in less than 1 year. That tells you something about the cash generation potential of this project. So yes, spot prices are obviously will have a huge impact, but in a definitive study, financing institutes, obviously they don't use spot prices, they use lower prices. And that's why we decided to publish this study using street consensus prices. That's basically an average of the analysts who are out there, which at the moment is $1,750. It seems like it seems like the screen is frozen. I can't see you anymore. We've come to the end of the webinar. We do have the outstanding, in case you can hear me, I'm just going to close off here and thank everybody for having made the time to be here. We do see there's some additional questions there. We'll try to answer them directly. We appreciate the time that you made to be here, and very much look forward to continuing to fast track this project. Thank you very much. Bye-bye.